the more bad economic news that we get out of China, we hear the more investors are optimistic about potentially fresh stimulus measures coming from Beijing, which we really haven't seen even at the Politburo meeting. So how do you position in a market where you're expecting this stimulus that's still to come?
Yeah, I think the way you think about the China macro is that the first half was really, really bad. And that was less to do with global developments and more to do with lockdowns in China. And as we move into the second half, you're seeing a natural increase or natural recovery in growth on a half-on-half basis. And this is really quite unique to China compared to what we're seeing in the rest of the world. And so when you talk about the policy stimulus measures, yes, there's been some disappointment around the, let's say, non-announcement out of the Politburo meeting last week. But if you look at what they've already announced so far, if they are able to implement that over the second half, there should still be a significant recovery in growth half and half.
And now you add to all of this uncertainty, the geopolitical tensions. Is this something that markets should position for, or is this already priced in the sense that we've been waiting for this trip for a while now, and US-China relations don't necessarily seem to be going anywhere at this point?
Yeah, US-China relations do tend to have a very significant impact on the China market multiples. So when they are improving, it can lead to at least 3 or 4 turns on forward PE improvements. And when they're deteriorating, you can similarly see declines in the forward PE of similar magnitudes. Now, obviously, the US-China relations aren't just related to this specific issue, but it weighs across, the trade negotiations, the ADR delisting concerns, geopolitics, and also the tech restrictions that have been put in place. So put them all together, we were looking at a situation in May and early June where it looked like US-China relations were improving. But really, over the last 4 or 5 weeks, this has been going the other way. And with the news flow overnight, it looks like this is not going to improve anytime soon. So this was some sort of an upside optionality for us going into the year end, but looks like the risks of that or the chances of that have reduced at this point.
When it comes to how markets really deal with geopolitical risk, is it safe to say that whatever kind of knee-jerk reaction we see tends to peter out pretty quickly? You see the initial reaction when it comes to the war in Ukraine, for example. Obviously, that then led to some significant or substantial inflation and supply chain concerns.
Yeah, there does tend to be some overreaction in the near term. And again, this is not specific to any particular issue, but just the way markets are structured, just the way investors are structured. When you see change, there tends to be an uncertainty premium priced in. And that leads to a larger move than you would naturally expect because of the specific change that is happening. And this uncertainty premium tends to fade over time. So this sort of an overreaction is entirely natural, especially when you see unexpected events, which markets are not prepared for or have not previously been able to price in.
I really find it compelling that you say the tactical preference for you is to go for growth over value, that there's been value crowding. What gives you the confidence then when it comes to the growth names, and what specifically are you constructive on?
Right. I would say that this is probably our highest conviction trade at this point, to be overweight growth relative to value. We also like quality in the region as a long-term anchor. And the reason for our preference for growth really has been there since mid-May, which was a combination of where we are in the cycle, a combination of what we're seeing in terms of macro variables, which is basically bond yields moving lower, and what at that point looked like value crowding. That crowding has started to unwind with the value underperformance that we've seen since mid-May, but we are still not at a point where we would say that value is super uncrowded and it's time to move back in. I think this is going to be the next big question for investors in terms of positioning, when to rotate back from growth and back into value, because keep in mind that our structural preference for value is unchanged since early 2021. We do think that this is going to be a multi-year outperformance of value with phases of growth doing well like we are seeing right now. And just like in the multiple years before that, where value was underperforming for a long time and there would be bursts of value outperformance, we are now seeing the same for growth.
We saw HSBC vowing to restore dividend payouts. Are you seeing dividend and yield plays a little bit more compelling in parts of Asia?
Indeed. So the other thing that lower bond yields does is make dividend yield stocks look more attractive. And in fact, if you look at the dividend yields across the region, they're really, really attractive right now. In fact, if anything, dividend yields have kept pace and even outpaced the increase in bond yields that we have seen. So a dividend yield minus bond yield has actually been rising over the course of this year, which is quite stark. And if you look at multiple stocks, there are many, many stocks which are currently yielding more than 6%, which is more than 2 standard deviations over the long-term average. And these are, even outside of the commodity plays, outside the transportation plays, there are many names in banks and tech which are offering very, very, very substantial yield, which investors are paying a lot of attention to. With the decline in bond yield last week, we did see yield stocks as a style perform the best last week, and we do think that this could continue in the near term.